Hey everyone, welcome back. Today we're diving into a concept that honestly is what separates the novices from the pros. We're talking about the alchemy of profit margins. And look, I want to bust a massive myth right out of the gate here. A higher percentage does not automatically mean a better business. We're going to see exactly why.
All right, let's jump right into a quick scenario. Imagine you've got a choice between owning two totally different companies. Company A gets to keep 25 cents of every single dollar it makes, while Company B keeps just 3 cents. So, which one would you rather own? Now, most people immediately point to Company A. I mean, it's obvious, right? Why on earth wouldn't you want to keep a quarter of every dollar instead of just 3 measly pennies? But here is the absolute wild part. Both of these companies are actually among the most wildly successful businesses on the planet. So how does that even work?
Let's unpack the formula. What actually is a profit margin?
At its absolute simplest, it just tells us how much profit a company gets to keep from every single dollar of revenue after all the costs are paid. Think of revenue as the top line. It's all the cash walking in the front door. But your net income, your actual profit, that's what you get to hold on to after you've paid all the bills.
The math here is wonderfully straightforward. The formula is literally just net income divided by revenue. It is one of the absolute most useful measurements in all of business, and we usually express the answer as a percentage. So just as a quick example, if a company brings in $100 in sales, and after paying for their products, the rent, taxes, all that fun stuff, they have $20 left over. You divide that 20 by 100, and boom, you get a profit margin of 20%.
This really illustrates exactly where that money is going. 80 cents of every dollar gets immediately eaten up just running the business, right? Paying employees, doing marketing, keeping the lights on. Only that 20% slice actually drops straight into the company's pocket.
So, moving on to the tale of two titans, Apple versus Costco.
Let's put their financials side by side. Company A, the one hoarding 25 cents on the dollar? Yeah, that's Apple. And Company B, scraping by on just 3 cents? That's Costco. Now, if you only looked at these percentages in a vacuum, you'd probably conclude Apple is just inherently the better business. But that's a totally incomplete picture. They aren't just using different strategies, they are quite literally playing completely different sports.
Let's look at Apple's high-margin empire. Apple is the undisputed king of the high-margin model. When you buy an iPhone, a Mac, or an Apple Watch, you aren't just buying a piece of hardware. You're buying premium design, this incredibly sticky software ecosystem, and a massive brand. Their customers are fiercely loyal, and that loyalty gives Apple incredible premium pricing power. They literally do not have to compete on being the cheapest option out there.
And that's the whole point of their overarching strategy, earning more profit from each individual sale. Because their customers value the products so highly, they're more than willing to pay top dollar. This lets Apple keep a much larger slice of every single transaction as pure profit, rather than having to stress about selling the absolute maximum number of devices.
Now contrast that with Costco's low-margin magic.
Costco's strategy is basically the exact opposite. If you walk into a Costco, you're going to see thousands of items priced just barely above what Costco actually paid for them. You see, their goal isn't to make a massive profit on one single flat-screen TV. Instead, they offer such undeniable value that millions of loyal shoppers are willing to pay a membership fee just for the privilege of walking through the doors. And that drives massive sales volume.
Which brings us to their core strategy. A tiny slice of a giant pie can still be worth billions. Sure, they make a minuscule profit on each individual item, but they completely make up for it through sheer incredible volume. It is the high-volume, low-margin model in its absolute purest form.
Let's break this down with a simple analogy. Luxury versus volume. Think about it like this. Apple is basically a high-end luxury jewelry store. They might only sell, say, 5 diamond rings in an entire day, but each one of those rings has a massive profit baked right into the price tag. Costco, on the other hand, is a grocery store. They're selling thousands of items every single hour, but they're only making pennies on each one. The thing to remember is, both of these can be incredibly successful, highly profitable businesses. They just create value and win the game in completely different ways.
So how do we use this? Let's look at investing like a pro with the investor's checklist. Here's the #1 biggest mistake new investors make: comparing apples to oranges, or in our case, comparing Apple to Costco. Context is absolutely everything here. You should only ever compare companies with similar business models operating in the exact same industry. Different industries just naturally have different economics.
A software company is almost always going to have higher margins than a warehouse retailer, and honestly, that's perfectly normal.
So instead of just blindly hunting for the highest percentage across the entire stock market, experienced investors actually ask 4 specific questions when they look at a company's margins. 1. Is the margin improving over time? 2. Is it stronger than its direct competitors, like comparing Costco to another warehouse club, right? 3. Does the company actually have a durable competitive advantage protecting that margin? And 4. Is the business consistently profitable, year in and year out?
And that brings us to our ultimate takeaway for this explainer. You have got to always understand how a business makes its money before you start judging its financial numbers. High margins absolutely don't automatically mean a better company, and low margins definitely don't mean a weaker one. It is all about how they execute their specific strategy to dominate their own unique market.
So, now you know how to look way past those top-level percentages and really understand the mechanics of profit margins. But, that leaves us with another absolutely crucial question. We know how much they keep from what they sell, but how efficiently is a company using your money, the shareholders' money, to actually generate those profits and grow even faster? Well, we're going to be answering that exact question in our next explainer when we tackle return on equity. You really won't want to miss it. See you then.